Hi everyone, Mapalo Makhu. I'm a personal finance columnist and published author of a personal finance book called You Are Not Broke, You Are Pre-Rich. This book right here. And today I will be talking all things personal finance. And the topic for my talk is how to manage your money in a smart way. All right. Now, there are 5 topics I will be touching on. The first one is budgeting and forming good money habits. I will be talking about your credit score, saving versus investing, getting ready for big purchases, and the last one, almost a sore topic, I will be talking about black tax. But before we begin, I always start with this question. How do you define wealth for yourself? What is the definition of wealth for yourself? Maybe take a minute to think about it. Answer that question in your head, because when you define what wealth is to you, it affects the steps that you take up when managing your personal finances. All right. So I also want to talk about the limiting beliefs we have when it comes to money, because oftentimes, because of our upbringing, because of our experiences, we have limiting beliefs when it comes to money. And what is a limiting belief? For example, someone will say, I grew up hearing that money doesn't grow on trees, as an example. That's a limiting belief. Yes, it does not grow on trees physically, but that was the psyche that, you know what, we don't have money, stop asking us about money here, right? It was dismissive. So you have to interrogate how you view money, because those beliefs, those things that you heard growing up, they in some way affect how you go about managing your money as an adult. So first of all, before we get into the course, before we get into the nitty-gritties, you have to interrogate your own beliefs about money. And hence my question, what does wealth look like to you, and what is wealth? All right. So I want you to do an exercise for me. Write down all your limiting beliefs. I'll give you another one. This is a very, very good one. I remember when I started working in corporate, there was an older lady. She was, I think maybe around 54, and she used to always say, Mapalo, moto opela ka sekoloto, right? That's what she used to say year in, year out. For as long as I was there in that company, that's what she used to say. And guess what? She was always in debt, all right? And for those who don't understand moto opela ka sekoloto, it means you cannot live without debt. So that was what she kept on repeating for herself, and that's what she believed. That was her limiting belief, and she lived that way. Every time at the end of the month on the 25th, she would be ducking and diving, you know, running away from calls, because that was what she believed about money. So what do you believe about money? What is your limiting belief? Now, you've interrogated that. Now, think to yourself, what is it that you want to believe about money going forward? That is my question to you, all right? So one of the things that I want to believe about money is that there's enough. I too can have a share of the money that is out there. I think the last time, I think this was about 7 years ago, there was almost 1 trillion circulating in the global economy. So I'm like, even if it's just 1%, I know 1% is a lot, but you have to believe that you too can become good with money. You too deserve to have money, because it is a means to enjoy your life, all right? So interrogate, what do you believe about money? And I think the most important thing as well is you need to forgive yourself for your past mistakes. You do not know how many people come to me and say, Mapalo, I've done so many mistakes. I've made such a mess of my finances that I just feel shame, I feel guilt. And I always say that, you know what, those 2 emotions are of no use to you. Absolutely no use to you. You need to look at your situation and say, I did not know any better then. But now, because of the information that I'm receiving from this course, from the information that I'm receiving from books, from the information that I'm receiving on the event with Sta Sof Fro, I am going to start making better decisions. So you need to forgive yourself for your past money mistakes. That is very important. That is how you move forward. All right. So that was more of the emotional stuff. But remember, I always believe that when it comes to money, it's more of your EQ than your IQ. What do I mean by EQ? EQ means everything that you think about yourself first, everything that you have come to know, all your experiences. That's how you end up managing your money. I can tell you about the numbers, I can tell you about all of that, but if you do not fix yourself first, it will be much harder to take all of these tips and go and practice them. You have to work on yourself first. You have to believe that you deserve financial success. All right. Okay. So now let us go into budgeting. What is budgeting? Budgeting should be easy. It's your income minus your expenses. And when I talk about budgeting, I am not talking about mental notes. Actually, a lot of the times people say, I have a budget. I'm like, no. You do not have a budget. You have mental notes of your expenses. You kind of have an idea that, okay, I spend so much on this, I spend so much on that. That is not a budget. A budget is something that is written down. It is physical, either on an Excel spreadsheet or an app if you are more tech savvy, but it's something that you have to physically see often. All right. So like I said, it is your income minus your expenses. All right. So when it comes to budgeting, oftentimes people say, oh, I'm bad with budgeting. And I'm like, no, you're not bad with budgeting. You just haven't done it long enough. You haven't been consistent long enough for you to realize that it is easy and it is doable. Okay. So when it comes to budgeting, there are a few things that you can do. All right. So when it comes to budgeting, like I said, it is easy. It's your income minus your expenses. All right. And you need to write it down. The thing when it comes to budgeting, it's not a one-size-fits-all type of thing. There are different ways to budget. And I think this is where people get it wrong. That, you want to use this method and someone has said it works for them. You have to find the right fit for you. It is called personal finance for a reason, because it is personal. You need to find what works for you, all right? And there are different ways of budgeting. Number one, and the one that I love the most, it's called 50, 30, 20% budgeting rule, okay? And this means that 50% of your income goes towards your needs, 30% goes towards your wants, and 20% either goes towards paying off debt or saving. But I always say a big but. You cannot tell me that when you are in debt, you will spend more towards your wants, which is 30%, than you do towards paying off debt. If you are in debt, you need to flip it around and say 50% is going to go towards my wants. This is your rent or your bond, insurance, food, that sort of thing, the things that you actually need. Then 30% because it was going towards your wants, things that you enjoy. And that's another thing. People often say, budgeting is so restrictive. I can't do it because, it means that I'm not going to enjoy my life. With this method, it allows you to enjoy yourself, meaning that 30% goes towards your wants. But if you are in debt, it means that 30% needs to go towards paying off debt because you need to crack down on paying off debt. Then 20%, of course, it goes towards investing, saving, if you don't have debt, of course, paying off your debt. All right. So that is the 50, 30, 20% budgeting rule. And I love that method. Then another one that I love, and I think this one is almost life-changing. It's primitive, it's old, but I think this one makes the most sense. And this is called the envelope system. The envelope, I wish I had an envelope next to me here. But the envelope system basically means that for areas of your budget that you struggle with, and I'm talking about, for example, here with me, my biggest struggle with my hubby is that we love eating out. Okay, COVID happened and maybe it helped a little bit, but we love eating out. We will go out and try different restaurants. So it would just knock out our budget, and we saw that we're spending so much money on eating out. So with the envelope system, it's saying, there's a category in my budget. I know it's a problem. I am going to draw money. And I know this sounds like, oh goodness, now I need to go to the bank. I need to go to the ATM. Hey. if you want to get your finances in order, you need to do whatever you need to do, okay? You need to go the extra mile. You need to do things that are outside of your comfort zone if you want to get your money right. And that's the whole thing, that a lot of the times people think, oh goodness, I want to get my money right, but I'm not willing to be uncomfortable. You have to be willing to be uncomfortable. You have to be willing to do the things that are not normal to you. So with the envelope system, you physically go to the ATM, you draw money out. So for example, for the category of eating out, let's say your budget is $1,000. Let's say your budget is 2,000, whatever your situation is, right? You draw that 2,000 rand and you put it physically in the envelope. You put it there, right? And you write on top of that and you say, this money, this category is for eating out and entertainment. Call it what you may, right? For some people, it could be that their problem is they buy too much airtime. You know how many, actually, do you know how many people lie to themselves when it comes to budgeting? People will always say, oh no, I spent 300 rand on airtime. In actual fact, you are spending $1,000. So you need to be honest with yourself when it comes to budgeting. That's another thing. You absolutely need to be honest with yourself. So with the envelope system, again, you write down, this is for eating out, this is for airtime, this is for drinks, whatever that case might be for you, and you put money into it. Throughout the month, if you are going to go eat out, you physically take money from the envelope and you pay for your food, for your entertainment. There is something that is so powerful when you see money just finishing. Yaphela, it's going, this thing. It is so powerful versus when you are swiping. There's something about swiping versus actually using cash that it's like a psychological thing, because you don't physically see the money going. You still think, you know what, okay, I've spent a little bit too much this month, but it's okay. But with the envelope system, you are forced to see the money leaving your envelope, and once the money is finished, that's it. You are done. You don't have any more money for that category. So the envelope system, for sure, I think works specifically and works nicely for those areas you struggle with. Here, I'm not talking about your bond. Please don't go draw 10,000, 15,000 and put it in an envelope. It does not make sense. It's for those areas where it's less than 5,000, where it's less than 7,000, or whatever the case might be, that you say, I struggle with this, but trust me, it works, okay? So I've mentioned two methods, 50, 30, 20% budgeting rule and using the envelope system. One thing I want to talk about also when it comes to personal finance is avoiding the lifestyle creep. What is lifestyle creep? Lifestyle creep means when you start working, for example, you start earning 10,000 as an example. Then you have never earned that money before, and it seems like a lot of money in the beginning, and you're like, oh my gosh, this is so much money, I don't even know what to do with it. But sooner or later, you get so accustomed to spending right at the top of your budget, spending that 10,000 that you have no room to save, you have no room to invest, you have no room to save for an emergency. You are literally right at the top of your budget. That is lifestyle creep, that whatever you make, you spend. And you want to avoid lifestyle creep by all means. Yes, it will happen because, as you go through your career, things will definitely improve, but do not spend to the very, very last cent. That is the quickest way to stay poor. That is the quickest way to stay poor. So you must always leave room and act like you earn less than you actually earn, if that makes sense. So for example, if you earn 20,000, act like you earn 18,000 and save the rest. That is the quickest way you will become financially free, all right? So avoid lifestyle creep, okay? Then another thing is one app that I actually like, that I enjoy, it's called the 22/7 app, okay? This app, it puts down the categories for you. You can link all your bank accounts, and I think it's really safe. I've used it before, so go check that out as well. Then I think, when I talk about personal finance, I don't just talk about numbers, because I know numbers, it's easy to know numbers, but what makes you tick, right? So my point is cut out expenses that drain you. And what do I mean cut out expenses that drain you? I'm talking about a lot of the times people go through life or their personal finance lives just by, what everyone else is doing. I'll give you an example of what I mean. When I had my first child, he's 6 years old now. I have two babas, two boys. When we had our first child, I remember someone, a friend, saying, and she meant well. She really did mean well. She asked me, okay, now that you have a baby, now that your baby's on the way, you're going to change your car, right? And I was like, I'm going to change my car. At that time, I was driving a Chevy 2007, like a little tiny thing. And they said, okay, so now you're going to change your car. And I was like, I'm going to change it for what? For who? This person is going to come out of me and they're going to be about this size. And now I'm going to change a whole car for them, right? So for me, what that has showed me over and over and over again is that people do not interrogate the messages that they receive from their environment. So oftentimes when people are about to have kids, they will say, you need a new car, you need to move to a bigger house with a yard and all. Those are nice to haves. But if it is not aligned with where you are in your financial life, it's okay to say, you know what, I'm not going to do that right now. If it's not aligned with what it is that you're trying to achieve in the long term, it's okay to say, you know what, that's not what I'm trying to do with my life right now. So cut out expenses that drain you. And expenses that drain you are those expenses that are not aligned with where you're trying to get to in life. If you can do that, you would have won half the battle when it comes to personal finance, believe you me, okay? So that is all things budgeting. And remember, budgeting is really just about reinforcing good financial habits. You do it often, you don't do it at the beginning of the year and forget about it. Oftentimes people say, oh, get 2021, it's a new year, new me. 2 months later, it's still the same damn you, okay? You need to focus on small increments. You need to focus on consistency. That's all personal finance is. It's reviewing what it is you've set out to do. So budgeting, it's something that you need to do consistently, even if it feels painful, even if it doesn't feel like it's working out in the beginning. Just like with anything, when you're trying something out, when you're trying something new, like I've just started on TikTok. I do not know what the hell I'm doing, okay? But I have started. I know it's going to be painful in the beginning, the learning, but eventually I will get it right. And you need to know that you too will get it right. That's the thing when it comes to personal finance. It doesn't always start off nicely. It doesn't always start off smoothly, but you need to be patient enough. You need to be willing to learn and know that it's for the long term, all right? So that is everything budgeting. Remember, it's income less expenses. You need to cut out expenses that drain you. You need to avoid lifestyle creep. Then 2 methods, 50, 30, 20% budgeting rule using the envelope system, and the app is called 22/7, all right? So that is everything budgeting. I know I'm always looking at time because, I can talk so much when it comes to budgeting. But maybe the last 2 things I want to say when it comes to budgeting. Number 1, adding to what I've said, is that you need to pay yourself first. Because oftentimes people are like, oh, but this budgeting thing, how do I, where do I go? How do I... If you want to start saving, which we're going to talk about in the next couple of minutes, is that you need to pay yourself first. Yes, you are allowed to be selfish. What does it mean to pay yourself first? Paying yourself first means that when money hits your account, and I'll always make a simple example of 10,000 because, it's just easier to do the minuses and the pluses, okay? If you're going to earn 10,000 bucks, like I said, you need to live like you earn 8,000 so that 2,000 you can start saving or investing, whatever the case might be, paying off debt. Paying yourself first is that I honor myself. I honor the work that I'm doing, right? Because, it's so strange to me when it comes to personal finance that you allow every Tom, Dick, and Harry to come into your account on the 25th, on the 30th, or whenever you get paid, to come and have a karate match there, debit order, and yet you leave nothing for yourself. So paying yourself first means that I honor myself first. Before Tom, Dick, and Harry comes into my account, I am going to put money aside for my future, for myself. Either because I want to go on holiday, or either because, I want to invest for my future later on, all right? So pay yourself first. Before a DSTV comes, before whoever else comes, make sure that a portion of that money is yours. Like, you know what? Now I don't compromise on that. I've never compromised on that. I remember when I started working, when I was in varsity, I used to earn 3,500 bucks, and 10%, 350 used to go to my investment. I didn't have any responsibilities, thank God. So 350 noma kanjani used to go to my investments. All right, so you need to honor yourself, and if you view it like that, and that's the thing about personal finance, you just need to change how you think about money. You need to change how you think about yourself. That's it, right? So don't rely on yourself. Don't rely on your self-discipline to pay yourself first, because we lie to ourselves when it comes to personal finance. If there's a topic, if there's one area we lie to ourselves, is finances, guys. So you need to automate. What do I mean by automate? It means that you do not want to rely on your self-discipline. How many times have you said to yourself, okay, at the end of the month when I get money, I will put money aside? It never happens, ever, because things start happening. And this is the message I get all the time. Oh, Mapalo, I always say that, I'm going to save, but, so many things come up. I'm like, yeah, well, you didn't pay yourself first and you didn't automate. So automating is basically saying to your bank, when I get paid on this day, I want money to be transferred, first of all, to my savings or my investments. So you need to automate, all right? So that is it. That was budgeting, okay? Now, we are going to move to your credit score. Guys, when I talk about credit score, I want to clarify, first and foremost, let me have my tea. One thing about your credit score is that it is not in caps. It is not an indication of whether you can afford something or not. Let's not get it twisted. A lot of the times when people talk about your credit score, they talk about it as if it's the be-all and it's the last thing. No, your credit score is not an indication of whether you can afford something or not. Your credit score is basically how you've handled money in the past, how you've handled credit in the past. So that's it. That's the definition of a credit score. Your lenders want to see, have you paid on time? Have you paid in time? That's your credit score. It has nothing to do with your affordability, all right? So when it comes to your credit score, they look at, have you paid on time, as I mentioned? Are you paying the right amount that you've agreed on? You don't skip 1 month and start paying the other month. That will mess up your credit score the quickest. So your credit score is very important because, for example, if you want to buy a house, you will need to approach the bank to approach the bank for them to give you a bond. Or if you want to buy a car, for a lot of people, you can't buy it cash. So you need to go for the financing route. So your credit score is important because that's what they will look at. They will say, okay, it looks like you've been paying all your debts on time, in time, the right amount, the agreed amount, consistently. And that's the thing, consistently, month in, month out. And they will make the decision based on that. If your credit score is poor, it affects the interest rate that the bank or the lender is going to charge you. If your credit score is poor, they will say, oh, you're not really trustworthy, so we are going to hike up your interest rate. So you need to work on your credit score because it means that if it's good, you're going to get better rates, preferential rates, and on that in turn saves you money in the long run, okay? So I know a lot of the times people say, I want to start building my credit score. How can I go about that? Unfortunately, you need credit. You can't just have a credit score without having credit. So you can either build it through having a credit card, but with that credit card, please don't go max it out, okay? And I actually did a video a couple of weeks ago where I said, with your credit card or any form of debt for that matter, if the bank says you qualify for 50,000 as an example, and you know you very well that you're earning 20,000, you have no business taking on a credit card for 50,000. How are you going to pay it off? It does not make sense. And that's the thing. Banks and lending institutions are there to make money. That's their mandate. They're not running non-profit organizations. Their mandate is to make money. And they will always offer you more than you can afford because people say, oh, well, I can take it. It feels good. But you can say no. You can say, you know what, I cannot afford this. What I can afford is X, Y. I always say, perhaps as a rule of thumb, only take on the amount of credit or credit card debt that you can pay off in 1 month. If you can't pay it off in 1 month, then you know you've bitten off more than you can chew, all right? So with the credit score, again, not an indication whether you can afford something or not. It's simply an indication whether you have paid your creditors on time, in time, and the right amount. So with your credit score, I think it's important, especially if you're going to buy a house or a car, because most of us can't afford to buy these things cash. So that's it on credit score. Basically, history of how you've managed credit in the past. You need to pay it on time. You need to pay it consistently. If you are experiencing problems, this is another thing. If you're experiencing problems with paying your debt, please don't bury your head in the sand and hope for the best. You're not an ostrich. You are a person, and these institutions would rather have you pick up the phone and say, you know what, COVID has affected my work, I'm earning less now, or I'm experiencing financial problems, I cannot pay you the amount that we agreed on. They are more than happy, they are more likely to say, okay, let's work out something in the interim that you are able to pay us, and that affects your credit score. If you start missing payments, it will mess up your credit score very quickly. So speak to your creditors. Like I said, they are more likely to negotiate something with you. But again, there are negative effects to that. If you pay less, of course, it means that you're going to pay this thing for longer and they're going to charge you more interest. But I would rather have that than ducking and diving and just saying, you know what, hey, I'll see. No, when it comes to personal finance, you will not see. When it comes to personal finance, you need to face things head on, all right? So that is your credit score. It's not an indication of whether you can afford something or not. It's simply saying how you've handled credit in the past. It affects the interest rate that your lenders will give you, all right? Then I want to talk about saving versus investing. This is an interesting one. And I want to make a big distinction between the two, because this is a distinction that you need to make before you start talking about money when it comes to saving and investing. So I have a quote for you here. It says, how many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case. I do not know a single person who is a millionaire or who's wealthy by just putting their money in the bank. Guys, money in the bank is to preserve your money and just have it sitting there nicely because you know that you're going to use this funds. So that's exactly it. Savings is putting money away for a future consumption. So within the next 24 months, you know that you want to buy a house and you want to save for a deposit. You use a savings account. That's savings. You know that your child is going to school next year. You want to make sure that the fees are taken care of. You put it into a savings account. So savings is for consumption in the short term. So savings is short term. Whereas investing, on the other hand, investing is for the long term. And what do I mean by long term? What do I mean by long term? Because when I say long term, people are like, oh no, 3 years. I'm like, you are still not at long term. You're still at savings. Long term means anything. I know some people say 5 years, but I would even go further and say 7 years, 10 years, 15 years, 20 years. All right. That is investing. Savings, like I said, they're important for short-term goals. For example, again, to build your emergency fund. Your emergency fund is a form of savings. Maybe let's discuss what an emergency fund is. An emergency fund is money that you will need if things pop up and they need money. A lot of the times, actually, people fall into the debt trap because they don't have an emergency fund, all right? So an emergency fund, I know experts always say have 6 months of your salary or of your expenses in a savings account where you don't touch. Have a year's worth of your expenses. I'm like, guys, this is South Africa. Not that many people have that luxury, okay? Yes, that is the ideal situation. That is where you want to eventually get to. But I often find that if I tell people have 3 months, have 6 months, have a year's worth of expenses saved somewhere, people automatically pull away and they're like, yeah, how do I even begin when I don't even have 100 rand saved somewhere? So for me, when I'm talking about an emergency fund, I always say start with what you can. If for you that amount is 5,000, if you have never put away 5,000 somewhere saved for an emergency, maybe start with that, right? Maybe start with 1,000, putting away 1,000 and saying, you know what, this is for my emergency. I cannot expect someone who has never ever saved for an emergency fund to start working towards 3 months, 6 months, or 12 months worth of their expenses. It's ludicrous, and this is the type of stuff that intimidates people and people just shut down. But I want you to work towards your emergency fund. Think of a number that's reasonable, and perhaps that one that pushes you a little bit outside of your comfort zone. Remember what I said in the beginning, that when it comes to personal finance, you do have to do things outside of your comfort zone if you want to get your finances right. So exactly the same thing when it comes to an emergency fund. Think about, okay, what is the amount that I can put away right now? What is the amount that I can work towards? So if it is 5,000, do that. Start working on putting 5,000 away towards an emergency fund. And once you've achieved that, this is the thing about personal finance. Once you achieve something, it feels like, hey, you know what? I have achieved that. I can do that. So it means that I can do more. If I can put away 5,000, it means that I can work towards 10,000, and you build from there. Remember, it's all about building blocks when it comes to personal finance. So that is your emergency fund. It forms part of your savings, okay? Then now, I want to talk about investing. I'm not going to touch on every single point because I think at the end of this course, I want you to do one thing when it comes to investing. Remember, we've spoken about saving. I want you to start putting money away for your emergency fund. Now, I want you to do one thing. I want you to action out one thing. And that's why I'm not going to talk about too many different concepts, because I want you at the end of this course to have action, to take out action and actually go do something about your personal finances. All right. So when it comes to saving, there are there's many vehicles that you can use to start investing. All right. For example, I've mentioned here, there's exchange traded funds, there's unit trusts, there's tax-free savings accounts, there's impact investing, there's shares, there's property, there's bonds, even business is another form of investing. But today, for this course, because I want to move you to action, I want to talk about tax-free savings accounts, okay? What are tax-free savings accounts? So tax-free savings accounts were introduced by the government. I think it was in 2015, if I'm not mistaken, or maybe a little bit before that. Yeah. And the whole point behind tax-free savings accounts is to encourage people to start investing or saving, right? Actually, before we go anywhere, the term tax-free savings accounts, I think is a bit misleading, and this is why a lot of people get it wrong. I would rather call it tax-free investments, tax-free investments. Yeah, instead of tax-free savings accounts. Because as soon as you say savings account, people start thinking, oh, it's a savings account, I can dip into it whenever I want. No, it does not work like that. All right. So your tax-free savings investment or your tax-free investment account, you can contribute a maximum of 36,000 rand per year. Okay, up to 36,000 rand per year. If you contribute more, if you want to contribute 37,000 because you have 1,000 rand more, they are going to charge you a tax on that. It doesn't make sense. So only contribute that up to 36,000 rand. So it works out to be 3,000 rand per month. But sometimes I get people who are saying, oh, but that's too much money. I don't have 3,000 rand per month sitting somewhere. It doesn't mean you can only contribute 3,000. You can contribute less, but you can contribute up to a maximum of 3,000, okay? Then you have a maximum lifetime limit of 500,000. What do I mean by that? Meaning that into a tax-free savings investment, you can contribute only up to a maximum of 500,000. And when do you reach that 500,000? I get people who will say to me, but Mapalo, it's going to take me forever. How am I going to get to 500,000? That's a lot of money. You get to 500,000, you reach the limit of 500,000 if you were to contribute the maximum of 3,000 Rand per month in just over 13 years, almost 14 years. So in 14 years, you would have contributed almost 500,000 into a tax-free savings account. What I love about tax-free savings account is that they are completely tax-free. That's why they're called tax-free savings account. So the answer is in the name. They are free from capital gains. They are free from interest. They are free from interest. They are free from dividends tax. So whatever you have put in there and coupled with compound interest, you will get out completely tax-free. The taxman will not want a cent of your money. When does that ever happen? I mean, if you earn a salary, you know how painful it is. You know how painful it is that you're looking at your statement like, yeah, man, I earn this much, but look at just how much comes into my account because of the taxman. So this is the one time where SAR says, whatever you have put in there and you add interest to it, compound interest to it, you will get completely as it is. So for example, right, I made an example assuming that you are paying 3,000 Rand per month into your tax-free savings investment, and you earn a compound interest of 9%, and you keep on putting money away for 15 years, your future value in 15 years time is 1.1 million, just over 1.1 million. So basically in 15 years, you can become a millionaire through your investments. And I know sometimes people are non-believers. They're like, oh, I have to wait for 15 years. And I'm like, do you know, I finished school in 2000 and, what year was it? 2011. Ooh, I can't remember. I might be wrong. But I finished school then, and now I'm in my 30s. I don't know how, time just went by so quickly. That's the thing. When it comes to investing, it's the same thing. So you might as well start and let time take, you might as well just start and let time do its thing. And that's the thing. When it comes to investing, the most important thing is time in the market, not time in the market, time in the market. So the sooner you start, the better it is for you, okay? So that is when it comes to investing. Like I said, I would just want to touch on tax-free savings investments because I think the others, it will be too much information because I want to move you to action, right? Yes, tax-free savings accounts can come in the form of unit trusts or exchange-traded funds, all right? I know some people love shares. They want to talk about shares. And I'm like, you know what? Barriers to entry for shares sometimes is a bit higher because you are buying a share of a company. So for example, if you were to buy MTN and the share price is trading at 40 Rand, it means that you need a whole lot more money versus if you were to invest in a unit trust or exchange traded fund under the umbrella of a tax-free savings investment, okay? I know some people love property, but again, property as well, you need money, you need tons of money to start investing in property. And please don't come and tell me, no, you don't need money to go into property. We're not gonna talk about that right now. You need money to start investing, any form of investment, all right? So the barriers to entry for a tax-free savings account are very low. And a platform that I actually really like is called Easy Equities. You can do it through Easy Equities. There, they don't really have a minimum. You can start investing from, I think, 100 Rand or 50 bucks. Then other asset management companies that I do prefer are Signia Asset Management, Prudential Asset Managers. I know Alan Gray does tax-free savings accounts. Coronation does tax-free savings accounts. Investec also does tax-free savings accounts. Remember, when it comes to investing, you want to invest where there's no high fees, because the higher the fees, the more it's going to eat away at your return. So you want to make sure that it is not costly holding this investment, all right? Then another thing I think is very important that I want to talk about is investing for retirement. If some of you are going to doze off, just bear with me and hear my argument for investing for retirement. I know some people don't like retirement annuities, and I'm like, you know what? It might sound sexy if you say, oh, I don't want a retirement annuity, but in practice, and remember, I used to work as a financial advisor, all right? And I would see people in their 60s, in their late 50s, who, if they did not have a pension or provident fund or a retirement annuity, they would have nothing. You know, they would have nothing, because oftentimes people are not disciplined enough to start saving for the future, because you're just like, I'm living now, you know, there's a house I need to take care of, I need to take care of kids, there are so many things. But if you're contributing either towards a pension, provident fund or retirement annuity, it allows you to have something for retirement. I have seen too many people that if they did not have any form of retirement savings at all, they would be broke in their retirement. And you do not want to be that. I do not want to be broke in my retirement. I don't want to live a lavish life when I'm young, then when I get old, I'm broke. It just, that is not pretty. That is not pretty. Don't do that to yourself, okay? So you need to consider investing in a retirement annuity or contributing to a pension or provident fund. And on top of that, I want to say this: if you're working and you have a pension or provident fund, I know it's much easier that when you change employers to say, oh, I have money here, I'm going to take it and pay off my debts and do all sorts of things. But remember, you're not just losing out. Let's say, for example, you've accumulated 100,000. You're not just losing out on the 100,000. You are losing out on the potential compound interest that you would have had on this money. Remember, if you start an investment today versus having started an investment 10 years ago, if I have started 10 years ago and it kept on going, it keeps on earning compound interest. And me starting today, I will never ever catch on to someone who started 10 years ago. Ever. Ever. That's how compound interest works, okay? So retirement annuities are very important, or pension or provident funds are very important, and they have that tax benefit, right? You can have a up to 27.5% tax deduction in every year. So if you contribute up to a maximum of 350,000, SARS can say, okay, here's your money back. If you contribute 1,000, SARS will take a look at everything else and say, okay, here's your money back. That's how a lot of people actually end up having some sort of tax refund, okay? And that tax refund, you can either use it to fund more of your pension, or you can use it to fund your emergency fund if you're just starting out, all right? What I also love about retirement annuities is that you cannot touch your retirement annuity until the age of 55. And some are like, oh, I want my money. I'm like, you want your money, né? You want your money, but most people do not have that discipline to put money away. So it protects you from yourself in essence, right? It protects you from yourself to say, you cannot touch this money until the age of 55. And normally, in hindsight, when people have retired, they look back and they're like, sure, I am so glad I couldn't access that money, because oftentimes life happens, we are raising kids, we have households to take care of, and we want to use money that is available to us. So that is a layer of protection for ourselves. And also with a retirement annuity, your creditors can't touch a retirement annuity. So they can't come back and say, hey, you owe us, we want to go for your retirement annuity. That's one investment vehicle that is protected by law, okay? Also, what I love about retirement annuities is that you can nominate a beneficiary. So God forbid something happens to you, your retirement annuity can go to your kids, your loved ones, your siblings, or whatever the case might be, all right? So it is great for estate planning. So again, I will say this: when investing, no matter what type of investment, always go for low cost investments. Yes, when it comes to investing, there is a cost. There's no such thing as a free lunch. But make sure that it is low cost. And again, you get access to this low cost investing through asset managers, not insurance companies. And that's a conversation perhaps I just want to touch on a little bit, is that investing, you need to go to an asset manager, someone who just deals with that, because normally the costs are much lower than that of life companies. So this means your insurance companies. And I know a lot of people have retirement annuities and other investments with life companies, but the costs normally are that much higher than when you go directly to an asset manager. So always make sure that your investments are with an asset manager. And I've mentioned them, and it's not because I specifically invest in them, but these are the ones that are coming on top of my head. It is Signia Asset Management, it's Investec, it's Prudential. I know Coronation, some people love Alan Gray, but also the Easy Equities platform. I think it's very, very easy and user-friendly especially for people who are just starting out. And for retirement annuities as well, there's a company called Marriott, okay? Marriott Asset Managers. So you can do that through them as well. Then maybe just to touch on something as well when it comes to investing. Oftentimes you hear people talking about, now I'm talking about investing for your kids as an added extra. People will say, no, I'm investing in an education policy, and I'm just like, alarm bells just go off. I'm like, you know what? Investing or putting money into an education policy, you can do the exact same thing in a tax-free savings account. You can do the exact same thing in a unit trust or an exchange-traded fund. It does not have to be an education policy. And normally, these education policies, they are rigged with costs. The costs are so ridiculously high that you end up with not so much money for your kids, right? And education policies, in actual fact, are endowment policies, and normally they are sold as tax-free. That's not true. That's not true. The way they are taxed is called the four-fund method. I'm not going to bore you with the details, but they're actually not tax-free, right? And they are normally sold to the wrong people. If you are below the 30% tax bracket, you have no reason having an endowment policy or an education policy. Do yourself a favor. If you want to invest for your kids, don't go for an education policy. Rather go for a unit trust, exchange-traded fund, or a tax-free savings account, okay? You will thank me later. Believe you me, all right? Then, so that is it on investing and saving. So saving, remember, it's saving money for future consumption. Whether you want to furnish your property, you've just moved in, you want to make sure that you have some savings for that, or you want to pay a deposit on a house or a car. That's what savings is for. So it's money that you are going to consume in the near future. And people are so used to using credit for everything, right? So for example, someone will say, no, I want to finish my house quickly now. And I'm like, when it comes to personal finances, you need to practice patience. We moved into a house. For a year, I did not touch anything. Like, we were stressed out. We was like, yo, buying a house is hectic. Okay, we did not do anything. Our small furniture from an apartment, we came with it, and it stayed like that for a whole year. Okay, because we are practicing patience. We know what it is we want. We know that we don't want to get into silly debt. And silly debt is buying stuff on credit, whereas you can wait. Patience. You can wait and say, I'm going to start saving so that I build up enough money to start buying my furniture. Now you're sitting on a sofa and kika skolodo. Come on. You have to think for yourself when it comes to these things, all right? So that's saving. Investing is for the long term. It's saying to yourself, I want to invest for my retirement. Or sometimes you can even invest for fun. So one of the things that I want us to do with my siblings, I'm very close with my sisters, is that we're putting money away to say, you know what, when we are 50, we want to take a whole year and travel the world, all right? Or you can do that with your partner or whoever, but also make investing fun. Don't make it like, oh my gosh, I'm depriving myself, investing, saving money, and getting good with your money can be fun and should be fun. So you need to set inspiring goals for yourself. That's the whole thing, and I hope that's what you get with this presentation. All right. So I just want to make a quick example about compound interest. Remember, compound interest or compounding interest is your money making babies, and those babies making more money babies. All right. So that is compound interest. Is that it's interest on top of interest. So I'll give you a simple example. So let's say Tando invests 2,000 Rand per month for 6 years from the age of 22, and she stops contributing at the age of 28, all right? But keeps her accumulated funds invested until the age of 65. So she's 22, she stops at 26, but she just leaves that money there, and it just keeps on earning compound interest until the age of 65. Then you have Michelle on the other hand. Michelle says, okay, at 28, only at 28, Michelle comes in and starts contributing the same amount until the age of 65. Who will have more money at the age of 65? Oftentimes people tell me, oh, no, it must be Michelle because she contributed until she was 65. This is where compound interest, this is the magic of compound interest, is that at the end of the day, Tando, the one who started earlier, is the one who will have more money. Tando will have just over 3 million Rand, while Michelle will only have 2 million Rand. And the secret here is time. The sooner you start investing, the better it is for you. And don't get fixated on saying, oh, I need lots of money, I need tons of money to start investing. You can start small and build up from there. Remember, it's all about building good money habits, all right? So now, I want to talk about getting ready for big purchases. Okay, I think this is very important because at one point or another, we all want to own a house, for our first property, we all want to have a car. So I'm not going to talk so much about a car because they are very similar. So what I will be saying about buying a house is very similar to buying a vehicle, all right? So this is getting ready for big purchases. And this is very important. I actually heard something this morning when I was on TikTok. Like I said, I'm trying to go on TikTok and figure it out. And someone was saying they love a German brand of a vehicle. And that person asked them, do you love the car because you just love it, or because you love the perception that people have of you when you're driving that car? And I find that a lot of the times we are driving around in cars that perhaps we can't even really afford, but we drive around in them because, Mapalo will think, I'm rich. Or, their perception of me is going to change. I'll give you an example. In my Chevy, when I used to go to the shops, I mean, even the car guys would be like, yeah, buy sister. But if I was driving a different car, hey, people's eyes are like, then she has money. And I'm like, the kind of car or, your possessions don't really say much whether you are really wealthy, whether you're rich. It's really just what you see on face value. So when we're talking about big purchases, you need to consider and think for yourself and say, do I operate from an internal locus of control, or do I operate from an external locus of control? And what do I mean by this? And these are psychological terms that, I discussed with a psychologist when I was writing my book. She says people who operate from an internal locus of control, yes, nice things are nice things. I want nice things too. I deserve nice things. But I don't do them because I think I will get respect from people. I don't think that if I will not put myself under financial pressure to own these things, all right? So that's operating from an internal locus of control. Internal locus of control says, I know that I'm worthy. I know that I'm enough with or without these possessions. Whereas someone who operates from an external locus of control is saying, hey, I will get respect if I'm seen driving a German car, if I'm seen driving a specific model. Even when you know that your finances are not right, you are just out there and you get that satisfaction from people for a little bit, but you go home, you're stressed out. So you need to define for yourself, Will you operate from an internal locus of control? I'm enough, I'm okay, whether I have those things or not. Yes, if you have them, perfect, sharp, but it's not stressing you out at night. Or are you operating from an external locus of control, okay? So getting ready for big purchases, a house, buying a property, I always say that you need to buy less house than you can afford. What do I mean by this? So banks, like I said, they're in the business of making money. They will tell you, Mapalo, you qualify for a 5 million rent house. And there you go, when I'm Mapalo, take 5 million rent. That's not making smart financial decisions. Smart financial decisions are intuitive. It's looking at your whole financial life and saying, okay, yes, I might qualify for 5 million rent worth of a house. I might qualify for a 1 million rent worth of a house, but I've looked at my affordability, and my affordability says that I can only go for a 700,000 rent house. Excuse me. And this is a smart way of doing things, because I always say that when you go for the very maximum of your budget, you are going to hold that house is going to hold you prisoner, because you can't even go eat out. You can't go on holiday, because now you're just, amen, this bond, if I don't pay it, then, like my financial life is a mess. Even when kids come around and say, hey, can we go for lunch somewhere? Yay, you are shouting at kids. No, you need to look at your finances and say, what can I afford, right? And how do you do an affordability test, right? An affordability test is saying, okay, I want this house and it costs X amount. Then you'll look at it and say, okay, if it costs, the bond is going to cost me 10,000, and say, for example, you're renting and you're paying 5,000. So meaning that you're going to increase your payments towards housing by 5,000. It means that 5,000 extra, you need to be putting it away in a completely different account altogether, right? So meaning effectively that's 10,000 rands towards housing. So for 6 months, you live like you own this asset. You live like, you know what, you are living in that house already, okay? So you're putting away 5,000 and you're not touching it. Halfway through the month, you're not saying, oh, okay, let me get something, let me go into it. No. Your affordability, if you can afford it and you're comfortable for that 6 months and you don't dip into that extra 5,000, you know that you're ready to buy this house. You know that you're comfortable. You know that actually this is the house that I can afford. And on top of that, that allows you not only to see if you can afford this house, it also shows you that, you know what, it's a good thing, because it will allow you to save towards a deposit. Because having a deposit, especially if it's for a house, it shows the banks that you're serious about home ownership. It says that you're not saying the banks must take on the full risk, and perhaps that will affect the interest rate that they will offer you. So make sure that you do your affordability test. Don't just go with what the bank says you qualify for, all right? Then when you are ready to buy, you've done your affordability test, you know that you can afford this thing comfortably and still enjoy your life. You need to shop around and negotiate your interest rate. You know how many people just are married to their banks? If the bank says, no, we'll give you a 9% interest rate, you just go for it. Guys, your banks, they are in it to make money. Yes, it's good to have a relationship with your bank or a banker, but you must always shop around for interest rate, because the higher the interest rate they charge you on your bond, the more you will pay for this house in the end, okay? Then another thing I think that is very important, once you own this house, I think it's very important to start paying a bit extra, because you will be able to pay off the house quicker. Oftentimes people say, I don't know, with houses, why do we have to pay it over 30 years? It's not a must. You can have a bond for 30 years, you can have a bond for 20 years, but you can pay it off quicker by just putting in a little bit of extra. If it's 200 rand that you have, do that. If it's 500 bucks, do that. It will allow you to pay off the house much quicker. And another thing I want to mention, when you're buying a house, you are not obliged to go with the same bank for your insurance. So normally it is collateral, because if anything happens to you, they don't want the hassle of trying to sell this property. They want to have their money and your family can deal with it. So that insurance, you don't have to have it with the same bank. You can go to any insurance company, you can go to another bank, as long as you have that insurance as a form of collateral. That is the most important thing, okay? So that is buying a house, buying a property. Buy less house than you can afford, have a deposit, do your affordability test, improve your credit score that we spoke about earlier, because the higher credit score, the more likely, again, like I said, that the interest rate will be lower. Shop and negotiate your interest rate, okay? Pay a bit extra into your home loan if you can afford to. And make sure and remember that the insurance does not have to be with the same bank, all right? Then, buying a vehicle. Also, another big purchase. You do not have to go with the maximum. Again, you have to go back to what I mentioned earlier. Do you operate from an internal locus of control, or do you operate from an external locus of control? Which one is it going to be? Okay? You must always operate with your highest priorities, what it is that you want to achieve, not because of what everyone else is doing. I mean, that's just, like I said, the quickest way to stay broke. All right? So again, just as with buying property, buy less car than you can afford. Yes, I want a Bentley Continental GT. I know the interior, but I'm not going to pressurize myself to start driving around in a massively expensive car. I know that I need to do my work. I know that I need to start earning way more money. Once I'm comfortable, I can do that. Again, patience. You need to practice patience. You need to have a deposit. Again, improve your credit score. You can also negotiate your interest rate, all right? And make sure that you are fully insured when it comes to cars, because anything can happen. And sometimes people say, but Mapalo, what if I start saving my premiums so that if anything happens? And I'm like, what if you get into an accident 2 months after you have bought it? You would have not saved enough in terms of insurance. Then you have to pay this thing cash. Just please get insured, okay? Just get insured. That's just not even up for debate. So that is it when it comes to big purchases. We looked at buying a house and buying a car. Oh, the last thing, and I know some people are going to give me heat for this, but I do not care because I think it's very important. Do not buy your car on balloon payment. Driving around in a car that you have a balloon payment for means you cannot afford it. What is a balloon payment? Balloon payment or residual payment is saying, for example, the car that you want is 400,000, but you can't exactly afford 400,000. So what will the salesperson say? The salesperson says, okay, it's 400,000, but I'll work out a deal for you that it's 300,000. Then they pack the 100,000 somewhere that at the end of the contract, then there's that 100,000 that's been waiting for you, plus interest, plus a little bit of interest. It does not make sense. If you do not have the 400,000 right now, what makes you think you will have it in the future? And then people say to me, oh no, but in the next 3 years, I would have improved in my career, I would have earned more. So then my question is, you want to spend your future earnings on debt? Guys, no. If you want to become financially independent, you have to make smart choices about your money, meaning that any future earnings are not going towards debt. Future earnings are going towards investments, savings, and really enjoying your life, not towards debt. And normally, people forget about this balloon payment. Then come 6 months later, before the contract ends, they're like, yo, I need 100,000. Then what happens? People opt to go for a personal loan to pay it off or refinance. And some people say, no, but you can refinance. I'm like, guys, do you know the definition of refinancing? Refinancing basically means that if you are going to change your car, you are going to add this 100,000 to the new amount. So if the car that you're getting, that you're changing into, costs 500,000, effectively you're going to make it cost 600,000. So it's actually not the true value, but now you've made it 600,000, you have to pay more. Or sometimes people roll it over into another balloon, then it's a mess. Just don't go for a balloon payment, guys. Please, all right? So that is it. I know I can go on and on about a balloon payment. I just loathe it. I don't think it's necessary. I don't care whichever way you look at it. I know some people talk about, no, but what if you own a fleet of cars? That's a different conversation altogether. I'm talking to a normal person who wants to drive a car and sell it out of after how many ever years. But also, again, interrogate. Why do you need to sell your car after 5 years or after 3 years? Who said it? It doesn't automatically break down after 5 years. All right, so you need to interrogate all these beliefs when it comes to finance so that it suits you and your pockets. All right, so that is it on big purchases. Now, I want to talk about I'm heading into our very last topic, and this is black tax. And I'm going to have a sip of my tea, which is cold now, because black tax is such a sore topic oftentimes. And I don't only want to call it black tax, but I think for me, it's taking care of one's family. It's not tax. It's because I think for most of us, myself included, if it wasn't for my siblings pitching in and helping my parents out, I perhaps would have not finished varsity. So I don't see it as a tax. I don't see it as a bad thing. And even for my book, I interviewed quite a few people who were talking or telling me about black tax, that normally people are very proud to help their families. I mean, that's Ubuntu. That's how we are raised. We need to help one another to get to the next level, right? But it becomes a problem when we are not honest with our families. I will give you an example. I know someone whom their mom was so fixated on them having a car that she was not honest with her mom to say, Mom, I actually don't earn a lot of money. I don't have that much money to own a car, because her mother was like, you, Umtanam is finished varsity and she must show that, she's finished varsity, she's working. But she was not making enough money. Her daughter was not making enough money. The mother went, bought a car in her name and asked the daughter, okay, this is how much you'll deposit into my bank account. That is such a predicament for someone. You want to make your parents proud. You want them to say, you know what, my child is successful. But guys, no one is successful when they finish varsity. I mean, I used to think that I was going to be a multi-millionaire immediately. No, it was not like that. It did not happen like that. I had to work my butt off. I'm still working my butt off to make sure that I have the life that I want. I'm not fully where I want to be, but it takes time. These things take time. You need to be honest about your situation. You need to sit down with your family and say, you know what? I know it can be tricky. You need to read the situation. If your family, you can speak openly about how much you earn, that's all right. But I know for a lot of people, it's not easy discussing those things. So you need to just say, you know what, this is how far I can help. If, for example, a month I can only help out with $500, tell them that that is all you can do. I know it's difficult. I know it can be challenging. I know it can be hard, but you need to be honest with your situation. Again, it talks to communication. Communication is key. You can't have your family thinking that you're richer than you really are. And yes, I mean, I think it feels good when people think that you're richer than you are. But in actual fact, if you're not, you need to communicate that this is how far I can help. And that talks to setting boundaries. I think people are so afraid of setting boundaries, but boundaries are a form of respect for yourself and for others. To say, I can only afford to give you $500, I can only afford to give you $1,000, whatever that situation is for you. If people are not comfortable with your boundaries, then they don't respect you. Simply put, people don't respect you. And it will be uncomfortable in the beginning, but sooner or later, people will have to live with your boundaries, all right? Then you need to budget for black tax and communicate what that budget is, okay? So you know very well that every single month you need to help out. Even if it's not every single month, maybe like once every 2 months, sometimes, consecutively. But set it aside, set a budget aside for black tax in your budget so that you know it's there. Even if they didn't ask for it that month, but have it as a line item to know and to be used to it, that you know what, I can live without 500 bucks, I can live without 1,000, I can live without 5,000, depending on your situation, all right? Then I think something that we don't talk about often when it comes to black tax or helping out your family is you need to find solutions together. And what do I mean finding solutions together? I mean, for me personally, and for a lot of people actually, I know there's something that happens when you are able to earn your own money. You become very proud of yourself when you're able to earn your own money, not always receiving handouts. I think it's the healthiest thing. So if, for example, you have cousins or siblings who have some sort of skill, if it's to do nails, if it's to do hair, you need to explore that and find a solution and say, okay, instead of me always having to give money, can you plait hair? Can you do nails to cover some of the expenses? All right, because also that's teaching them discipline, that's teaching them that you need to actually work, and also it's exercising and putting into action those skills and making an income for yourself. So find solutions together and say, what is it that we can do as a family that perhaps for the next 2 months, I will save so that you can start a business. I will save so that you can start a side hustle, so that you yourselves here at home can start earning some money. All right. Again, I always say black tax or helping out your family, whatever you want to call it, it's always a very touchy subject, but you have to be practical when you are approaching it. So that is it. Be honest with your situation. Communication is key. Set boundaries, budget for black tax, and find solutions together. All right. So one of the last things I want to touch on, I'm left with literally just 2 things, is the net worth calculation. I love this calculation, and I know I say it all the time. If you've seen my videos, if you've seen me speak, I say I love this calculation so much because the net worth calculation, what is it? First of all, the net worth calculation is your assets minus your liabilities, okay? Your assets, this means your house, retirement savings, shares in a company, any type of investment. So your assets minus your liabilities, everything that you owe. Your net worth calculation shows you whether you're moving in the right direction or not. If your assets are more than your liabilities, it means that kudos to you, you're moving in the right direction. If your liabilities or debts are more than your assets, on the other hand, it means that you need to take a step back and say, okay, what is it that I want to achieve, right? So I love this calculation because for me, it informs the decisions that I make. I don't drive a fancy car because I know I want my holidays. You know, doing this calculation actually for me has shifted my thinking when it comes to my own personal finances, because I always think about what is it that I want to achieve, which brings me to the very last point, future me, the future me exercise. And I make my clients do this when I do webinars, when I do training, when I do my workshops. I always ask this question: 5 years from now, what do you want your financial future to look like? If you can envision yourself 5 years from now, as you are currently, and the actions that you have been taking, what is your financial life going to look like versus what it is you actually want? Remember, financial success does not happen by accident. Success does not happen by you wishing for it. It happens by you taking the action, the necessary action, paying off your debt, starting to save, having an emergency fund, but most importantly, changing your mind and saying, I will operate from an internal locus of control. I will operate from knowing what it is that I want, and my actions will support what I want. Okay, so future me exercise is very much aligned with your net worth calculation. What will my net worth look like? Even if it's just an increase every single year by 1,000, by 10,000, by 100,000, whatever that case might be for you. But you need to ask that question for yourself and have it somewhere where you can see it. Like I always say, people laugh at me. I say, for me and my hubby, we actually have the future me exercise and our net worth calculation by our wardrobe. So when we wake up, open it, we see it. Then that informs the actions and the decisions that we take. So If it's buying less house than we can afford, remember I spoke about that earlier, we do that because we know that we are working towards having more investments. If it's owning one car, for example, or buying less car than we can afford, we're not driving around in German cars. Maybe he can, but I'm not. But I know the future that I want for myself. I know the type of lifestyle I want for myself. I want to travel whenever the hell I want to. I'm not going to be enslaved by my house. I'm not going to be enslaved by a car. You need to think about your priorities. You need to say, this is what I want. In 5 years' time, this is what my finances are going to look like. And I am going to back it up with action. I hope you've enjoyed this online course because I have enjoyed talking to you about it. And thank you so much for joining, and thank you for staying on until the very last minute. Bye for now.